Hey there, I'm Merlin. Mithrandir is tired, so I'm your financial wizard from now on. Today I'm going to break down these 4 types of investment funds, which are index funds, mutual funds, hedge funds, and ETFs, in the simplest way possible. By the end of this video, you'll understand what each one is, how they work, their pros and cons, and most importantly, which one might be right for you. Before we dive in, please remember this video is for educational and informational purposes only. I am not a licensed financial advisor, and nothing you see here constitutes financial advice. I'm simply explaining how these types of funds generally work. Any examples or scenarios used in this video are purely to simplify complex concepts and aid in understanding. Always do your own research or consult with a qualified professional before making any investment decisions. So grab a snack, get comfortable, and let's dive into the world of investment funds. Section 1. What is a fund? Before we talk about the different types of funds, let's understand the basic concept using a simple analogy. Imagine you and your friends want to order pizza for a party. There are 4 different pizza places, each with amazing specialties. One makes the best pepperoni, another has incredible veggie options, the third is famous for its meat lovers, and the fourth has the best dessert pizzas. You only have $20, which is enough for one pizza from one place. But what if that one pizza turns out to be terrible? You've wasted your money and everyone's still hungry. So here's what you do. You ask 3 friends to chip in $20 each. Now, you have $80 total. You can order 1 pizza from each restaurant. If one pizza is disappointing, no problem. You have 3 other delicious options to enjoy. This is exactly how investment funds work. A fund is like a big pool where your money gets mixed with money from hundreds or thousands of other investors. Instead of buying pizzas, this pooled money buys different investments like stocks, bonds, or other assets. For example, let's say there's a fund called Super Grow Fund with $1 million. The fund managers decide to invest $200,000 each in 5 different companies: Apple, Amazon, Google, Netflix, and Tesla. Each company represents 20% of the fund. Now, when you invest $100 in the Super Grow Fund, your money gets spread across all 5 companies. So $20 of your investment goes to each company. With just one purchase, you now own a tiny piece of 5 major companies. Section 2. The 4 types of funds explained. Type 1. Mutual funds. Think of mutual funds as restaurants with professional chefs who decide what to cook based on what they think will taste best. Mutual funds have been around since the 1800s. They're the granddaddy of all funds. Here's how they work. Professional fund managers actively decide which stocks to buy and sell. They're constantly researching companies, analyzing markets, and making decisions to try to beat the market. Mutual funds come with several key features that set them apart. They are run by professional managers, people with finance degrees and expertise, who make all the investment decisions on your behalf. These managers actively trade, buying and selling stocks regularly based on market conditions in an effort to maximize returns. Because you're paying for this professional expertise, mutual funds usually charge higher fees, typically ranging from 0.5% to 2% per year. Getting started often requires a minimum investment, usually between $500 and $5,000. And unlike stocks, which you can trade instantly during market hours, mutual funds only allow you to buy or sell once per day after the market closes. The price you pay is called the net asset value, NAV, calculated at the end of each trading day. If you place an order at noon, it won't execute until after 4 p.m. when the market closes. Some well-known real-world examples of mutual funds include Vanguard's VPMAX, Fidelity's FBGRX, and T. Rowe Price's TRBCX, each of which gives investors access to professional management, active trading strategies, and diversified portfolios. Now that you understand how mutual funds work, so let's talk about the next one. Type 2. Index funds. If mutual funds are like restaurants with chefs, Index funds are like buffets, where the food is already chosen and laid out for you. Index funds were revolutionized by Jack Bogle in the 1970s when he got tired of high mutual fund fees. Instead of paying expensive managers to pick stocks, index funds simply copy a list of companies called an index. Now you might be thinking, what's an index? Well, think of an index as a shopping list of companies. The most famous is the S&P 500, which includes the 500 largest US companies. When you invest in an S&P 500 index fund, you're buying a tiny piece of all 500 companies automatically. Other popular indexes include the NASDAQ 100, which highlights major technology companies such as Apple, Microsoft, and Amazon, the Dow Jones, which tracks 30 large established companies across a variety of industries, and the Russell 2000, which focuses on smaller, up-and-coming companies. Index funds have a few key features that make them stand out. They're passively managed, meaning no human is constantly making buy or sell decisions. The fund simply tracks a chosen index. This also keeps costs extremely low, with fees usually ranging from just 0.02% to 0.20% per year, which works out to about $2 to $20 annually on a $10,000 investment. By investing in an index fund, you also get broad diversification, since you instantly own shares in hundreds or even thousands of companies. Like mutual funds, however, index funds follow the same trading rules, so you can only buy or sell once per day after the market closes. The beauty of index funds is their simplicity. If you believe the overall economy will grow over time, you can just buy an index fund and ride along with the market's growth. Type 3. ETFs. ETFs, or exchange-traded funds, are like food trucks. They offer similar food to restaurants, but with more flexibility about when and where you can buy. ETFs were created about 15 years after index funds and combine the best features of stocks and index funds. Most ETFs are passively managed and follow indexes, just like index funds. What sets ETFs apart from index funds are a few key differences. With ETFs, you can trade in real time, buying and selling shares anytime during market hours, just like individual stocks. They also come with a much lower minimum investment, often just $1 or the price of a single share, making them more accessible. Unlike index funds, ETFs provide instant pricing, so you can see exactly what you'll pay or receive at the moment of the trade. Plus, they offer more flexibility, allowing investors to place different types of orders, such as limit orders or stop losses, to better manage their strategies. Some popular examples of ETFs include VOO, the Vanguard S&P 500 ETF, which tracks the performance of the S&P 500, QQQ, the Invesco NASDAQ ETF that focuses heavily on technology companies, VTI, the Vanguard Total Stock Market ETF, which gives investors exposure to virtually every U.S. stock, and VT, the Vanguard Total World ETF, which goes even broader by owning stocks from around the globe. But there is a catch. While the flexibility sounds great, it can also encourage bad behavior. Because you can watch ETF prices change all day and trade anytime, some people become obsessed with checking prices and making emotional buy and sell decisions. Type 4. Hedge funds. Hedge funds are like having a world-famous private chef who uses exotic ingredients and experimental techniques. Amazing results are possible, but expensive and only available to the ultra-wealthy. Hedge funds are private investment pools that use aggressive strategies to try to generate massive returns. Instead of just buying and holding stocks, they might short sell, betting that certain prices will fall, or use leverage, borrowing money to invest more than they actually have. Many hedge funds also trade complex derivatives and other exotic investments, while some make very concentrated bets on specific opportunities, putting large amounts of money into just a few positions in hopes of outsized gains. Hedge funds come with some key features that make them very different from regular investments. To even get in, you usually need sky-high minimums, often starting at $100,000, and sometimes climbing into the millions. On top of that, they're notoriously expensive, following the famous 2 and 20 fee model, charging a 2% annual fee plus 20% of any profits earned. Legally, only accredited investors, those with a high income or net worth, can participate. And while hedge funds promise the potential for massive gains, they also carry equally massive risks, making them a true high-risk, high-reward investment option. Some of the most famous hedge funds in the world include Bridgewater Associates, known for its global macro strategies, Citadel, which has built a reputation for aggressive trading and high returns, and Renaissance Technologies, famous for using complex algorithms and data-driven models to dominate the market. Section 3. The Great Performance Showdown. Now for the million-dollar question, which type of fund makes the most money? You might assume that expensive, actively managed funds with brilliant managers would beat simple, passive index funds. But the reality is shocking. In the United States, about 80 to 90% of actively managed mutual funds and many hedge funds fail to beat simple index funds over 10-plus year periods. This happens because beating the market is incredibly difficult. Even professional managers with entire teams of analysts struggle to consistently pick winning stocks year after year. On top of that, fees quietly eat into your returns. A 1.5% annual fee might not sound like much at first, but stretched over 20 years, it can add up to hundreds of thousands of dollars lost. Active funds also face the challenge of market timing, and under pressure, they often end up buying high and selling low, which hurts performance. Index funds, by contrast, simply capture overall market growth. They'll never outperform the market, but they also won't dramatically underperform, making them a steadier long-term choice. Let's look at a simple real-world example to see the power of fees over time. Imagine you invest $10,000 and leave it to grow for 30 years. If that money is placed in an actively managed fund, which earns about 8% a year but charges a 1.5% annual fee, your net return falls to 6.5%. Over 3 decades, that turns your $10,000 into around $66,200. Now compare that with an index fund, which also earns 8% a year but charges only 0.05% in fees. Here, your net return is 7.95%, and after the same 30 years, your $10,000 grows to about $99,240. The difference is striking. You end up with more than $33,000 extra, simply because the fees were lower. This shows how small percentage fees may look harmless, but when compounded year after year, they can quietly drain away a huge portion of your potential wealth. Okay, I know what you are thinking right now. It's too much information to process. Don't worry, I got you. Here's the quick summary. Mutual funds. Professional management, higher fees, good for hands-off investors who don't mind higher costs. Index funds. Ultra-low fees, broad diversification, perfect for long-term investors. ETFs. Same benefits as index funds, but with trading flexibility. Hedge funds. High-risk, high-reward options for the ultra-wealthy. For most people watching this video, index funds or ETFs tracking broad market indexes like the S&P 500 will be your best bet. They're simple, cheap, and historically effective. Remember, investing always involves risk, and you should never invest money you can't afford to lose. Consider consulting with a financial advisor if you're unsure about your specific situation. If this video helped clarify these confusing investment terms, please give it a thumbs up and subscribe for more beginner-friendly finance content. Check out this video popping up on your screen to understand how stocks work in the simplest way possible. I'll see you there.